Introduction to taxes. An individual income tax is levied as a percentage of wages and salaries, with some deductions. Typically collected on a pay-as-you-earn basis. Tax laws typically offer exemptions, deductions, or credits, which lessen the total tax liability. Tax laws may allow losses from one type of income to be counted against another. Example, before calculating the taxes due, a loss from businesses and investments might offset wages. Form 1040 is the form people use to report income to the IRS, claim tax deductions and credits, and calculate their tax refund or tax bill for the year. The IRS releases a revised version of the form each tax filing year. Tax is figured on the basis of the income you receive and the expenses you incur during a tax year. Filing status depends on whether you are considered married or unmarried on the last day of the year. It is used to determine if you are required to file a return, the amount of your standard deduction, your tax rate, and your eligibility for certain deductions and credits. Income. Employees receive Form W-2. Self-employed receive Form 1099 NEC usually. Other income. Interest, dividends, investment, and rental income. Tax credits reduces your tax. There are two categories: non-refundable credits and refundable credits. Most tax credits are non-refundable. The amount of the non-refundable credit is subtracted from your income tax liability. A refundable credit reduces your tax liability dollar for dollar. This means that a $500 tax credit actually takes $500 off the tax balance due.
Subscribe for upcoming learning videos.